All right. What is up, traders? What's up, tycoons? Super excited for today's video. Japan has shocked global markets by raising 25 basis points. Okay. Meanwhile, the US raised 550 basis points. I think this meme is absolutely excellent. Now, this ended up resulting in the second largest drop in the Nikkei. All right. The 1 day drop, second largest 1 day drop ever. Okay. Negative 14.9%. So we'll just call it negative 15% on Black Monday. And here, a lot of people are referencing this as perhaps the next Black Monday with over a 12% drawdown in a single day. Now, the VIX also crossed 60 in a 9% drawdown currently. We're going to go over TLT because I know a lot of people watching this video are here for TLT. We'll give an update on my Elliott wave count. It's been going beautifully. Things are working very well, and we've been able to profit and strategize off of this. And we'll take a look at the TNX, which is going to be your 10-year treasury yield. This isn't necessarily the one that TLT is based off of, but when it comes to treasury yields, the TNX, the 10-year yield, is the one that everyone pays the most attention to. We'll also break down the weekly time frame, do a weekly time frame analysis and update on the chart. If you guys have been watching the channel or in the Discord, you guys know that three very important things happened here on the weekly time frame, and we did get the breakout and hit our upside target. We'll go over the daily chart breakout as well, just giving you guys some updates on the progress and status of TLT and some of the charts that we've been sharing with you guys. Now, we'll also go over the bearish cycle completion, so that way you guys can get a bigger picture, larger time frame, sense of what I think is going on. And we've got to talk about the stock market, okay? We'll go over SPY, break down what's been happening in SPY on the weekly time frame, how we've actually just put in a higher low on a very strong uptrend, and go over what happens every single time we get these bearish engulfers. We got a bearish engulfing chart here recently, or candlestick recently a few weeks ago, and we were basically warning everyone in the Discord that, hey, this has always led to a sell-off, and we'll break that down in more detail. But when you zoom out on things, okay, guys, and we look at a monthly time frame chart, we're still in a very, very healthy uptrend, right? If we go to a daily chart, we can perhaps map out a potential bearish scenario. So I'm not going to tell you guys what's going to happen, right? I can't predict things. I don't have a crystal ball. But what you can do is you can plan for different scenarios, right? And so all of the larger time frames, such as a weekly and a monthly, they are extremely bullish, okay? Now, when you zoom down to a daily, there is a bearish scenario here, which could then further change some of the bullish weekly and monthly time frames. But we have to wait and see, okay? And that's what we're going to do right now is we're going to be patient. We're going to dive into these charts, break them down so you have a complete, full understanding. And then there's also something really interesting that I want to break down with you guys about the 50 SMA simple moving average when it comes to the stock market, the S&P 500. It's really good, just general info to always keep in mind, right? And it's honestly something that I don't think a lot of people know or really realize. So I'm very glad to bring that to your attention, and you guys are going to be really interested to find out about it. All right, so make sure to stay to the end of the video so you don't miss it. We'll talk about the VIX crisis spikes and how, when you look at the VIX, we had the great financial crisis, the global pandemic, and here what happened was Japan raised 25 basis points, right? I mean, it's really insane what we've seen. Now, we'll also go over some really interesting data on top of charts. Okay, we'll talk about COVID era savings. We'll talk about a global credit crunch. We'll talk about how there's no bubble in tech employment. So a lot of people are screaming about this bubble in tech, in big tech. But when you actually look at employment and the employees, it really provides a much different perspective, okay? And then we'll talk about how basically every single year in the stock market has had a drawdown of 5% or worse. And we'll talk about Berkshire, all right? Everyone's screaming about, Warren Buffett selling his Apple and having such a large cash position. It's really nothing insane when you actually look at the construction of Berkshire Hathaway and their cash and equivalents to market cap. We'll talk about the reverse repo facility usage, how it just shrunk below 300 billion, and we'll go over the CTA cheat sheet here and go over what that potentially means in the future. Now, it's going to be a really great video, but as always, the content provided on this channel is for informational and educational purposes only. It's not intended to be relied upon as legal, financial, or investment advice. So be sure to read through the disclaimer. And if you're new to the channel, I started a completely free newsletter for you guys. Okay, it's called Investment Intelligence, and I give out free, valuable finance and trading related content, and I also sprinkle in free trade ideas inside of there as well. Now, there is a website associated with it. You can go back, review some of the previous articles and newsletters that have been written, see if it's something that you guys would enjoy and want sent directly to your email inbox. If so, you can sign up on the website or using that link in the description down below. Now, I am doing a promo code for the Investment Intelligence Private Trading Group. Promo code SUMMER will get you into the Discord for just $1 for your first month. And I'm doing that because all of July, I forgot to do a promo for 4th of July. And to keep patriotism alive in the midst of an assassination attempt, I'm doing a promo code SUMMER. Maybe I should change that to promo code Trump Daddy. Now, what's inside of the Discord? You get 20 plus swing trade ideas weekly, custom scripts and indicator, exclusive intel, and exclusive chart layouts. And I'm actually adding 5 new features, or basically sectors to there. We're going to have the zone finder. We're going to have the volatility compression. And then we're also going to have a lot of things coming very, very soon, and the price is going to go up on the Discord. So get in while you can, lock in those prices before prices increase. Now let's get into the juice of the video, okay? Let's talk about Japan raising 25 basis points. And meanwhile, the US raised over 550, and the whole world is shocked, right? I mean, everyone's screaming about a recession now. I did a video, my last and most recent video was titled The Recession Obsession. And I broke down basically everything that, could be causes for concern or valid reasons for people to be obsessing over a recession. But, just a couple months ago, everybody was screaming about the bull market and how everything is going up. And people are very emotional and they flip-flop very, very quickly. Now, this resulted in the second largest one-day drop in the Nikkei ever. Okay, this is your Japanese stock index, basically. And if you take a look at the one-day change, all right, we talked about it previously. Black Monday was a negative 15% drawdown, and we had about a negative 12.5% drawdown. So it's not like this isn't a big deal. This is a big deal, but it's largely a result of the carry trade. Now, I'm not going to dive super deep into the carry trade. Just understand this. What it was you could take out a loan in Japan, okay, with basically no interest, right? Take out that loan and put it into either US stocks, right? And US equities if you are someone who's looking to do high risk. Okay, so imagine if someone took out a loan in Japan at the beginning of the year, put that into NVIDIA, and then it skyrocketed higher afterwards, right? Or what a lot of people were doing was they were taking those loans out in Japan and then going and buying US Treasury bonds. Why? Because those are generally known as a risk-off asset. So you're not being super risky, but you could get a 4 to 5% yield on US Treasuries at the moment, right? On short-term and long-term duration. So why a lot of people were doing what's known as arbitrage and taking these loans out with extremely low interest rates and then going somewhere where they can collect a yield and pay off the interest but have an overlap, right? Have excess profits as a result. And so what happened was when Japan raised their interest rates, although it was only 25 basis points, what happened was a lot of hedge funds, okay, a lot of mutual funds, and things of that nature. Not only did they get margin called, but a lot of them that didn't get margin called, they simply just liquidated that position, right? And liquidated that trade. They said, okay, well, hey, the carry trade is coming to an end. Maybe Japan is going to start raising their interest rates. And from the last FOMC meeting, it seems very likely that we're going to actually start seeing US interest rates start to decline and potentially get a Fed rate cut. So if the whole theme and idea of the trade was, hey, take out these loans in an area where it's extremely low interest rates and put it into somewhere where there's much higher interest rates, and that's changing where the very low interest rates are starting to rise and the high interest rates are potentially about to start to decline, there was a lot of unwind, okay? The big thing about that is if you're not a mutual fund or if you're not a hedge fund trader and you're not someone who's participating actively in the carry trade, don't act like you're trading actively in the carry trade, right? There's no reason for you to freak out over a liquidation or margin calls of people participating in the carry trade. Yes, did that affect US equity markets? Did that affect US bond markets and treasury yields? Yeah, it did. But it was much more of an, over exaggeration of the move because of the result of a lot of people closing out of and getting margin called and liquidated out of this carry trade. Okay. Not much has changed besides the carry trade coming to an end. Okay. If you were bullish a month ago, there's a few things, maybe unemployment and the unemployment rate, but the whole world hasn't changed just because the Japanese carry trade is ending. Okay. And that's really all I have to say about the matter. We're not going to spend too much time on it, and I don't want to debate a bunch of people about it. Now, let's go back into US equities, right? The VIX crossed over 60, and we're in a 9% drawdown. Now, what has happened when VIX has crossed 60 previously? We've been in 50% corrections. We've been in 34% corrections, right? Drawdowns. We're only in a 9% drawdown. So this really just goes to show how exaggerated and accelerated this move was in volatility in the market and, in a sell-off. And as I explained just previously, it was largely due to the carry trade. Okay. It's a much different environment than what we've seen in the past, especially when it comes to the VIX. And once you start to understand that, it really starts to change a lot of perspective in the market for you. Okay. We're not in the middle of the great financial crisis right now. We're not in the middle of the dot-com bubble. We're not in the middle of the pandemic, right? I mean, literally, when you look at this, we had the great financial crisis and we had the COVID-19 pandemic. Those were the only other two times where the VIX crossed above 60, guys. And what did it this time? Japan raising 25 basis points? It's just not the same to me, okay? And that's why I'm saying if you're not a part of the carry trade and you're not someone who got liquidated or margin called or is closing that trade, don't act like you are. Okay. There's no reason for you to go in an extreme panic and extreme fear just because of that. All right. Now, 94% of all years have a drawdown of 5% or worse. 64% have a drawdown of 10% or worse, right? And we're right there at that borderline of a 10% drawdown right now in the stock market. Okay. It's not going to be the end of the world. This is very, very common, right? This is very common for things to happen within essentially the past 100 years of the stock market being around. So could we potentially head to that 15% or worse? Yeah, we could, right? We see about 40% of those. So that's less than half. Currently, we're right around here in this 10% or worse drawdown area, if you ask my opinion, which again is 65 or, roughly 65% of the time, right? So it's not something that is rare. It's not something that, it should strike you by surprise. It is very common for the stock market to have these type of corrections. And we know generally the stock market is in an uptrend and is overall bullish. Okay. So you can't get shocked. You can't panic sell every single time that there is a 10% drawdown or even a 5% drawdown in the stock market. Now, COVID era savings have been depleted as credit card delinquencies reach new highs. Okay, so we're not just going to ignore all of the bearish data. Okay, I just did, as I mentioned previously, a video, containing a lot of the really good data sets that people are obsessing over and causing this recession obsession. They are valid, all right, but we're not right now smack dab in the middle of a recession. Now, something to watch out for, okay, is going to be these credit card delinquencies, right, reaching new highs. This points to weakening consumer spending, right? And this is what you're going to hear from the bears, right? So if you're a bull, you want to have your bearish, you want to hear the bearish side of things, right? You want to hear the bear thesis. You want to understand these things so you're not going to be caught blindsided, right? So this is something that I think is very important right now. Now, Ed Yardeni, all right, he says that we don't think the Fed will be that responsive to this pullback unless a global credit crunch results from the yen carry trade unwind. We're sticking with just one cut in September for the rest of the year. No recession, no bear market, and this too shall pass. Now, this is a really interesting take right here, and it's not something a lot of people are going to agree with. A lot of people are either going to tell you, One, we're heading into a recession. They're going to tell you, two, the Fed is going to cut multiple times this year. And three, they're going to say that, this correction is just now starting. So I really like this perspective. I definitely think it's something to keep in mind. Professor Ed Yardeni is very well respected in the community and is someone I think that you guys should pay very much attention to, his information that he puts out. And it's definitely worth following his research and things like that. Now, compared to the early 2000s, there is no bubble in tech employment. So when we talked about the VIX, okay, being at those extreme levels, it wasn't even that high during the dot-com bubble, right? And a lot of people are comparing right now to the dot-com bubble because of the surge in AI-related stocks. But when you take a look at the, tech employment, okay, and tech employment levels, it's still on a downtrend. Okay, take a look at the dot-com bubble era, and we just see a massive amount, right? This is a tech share of US employment as a whole. So over 5% of all US employees were working in the tech industry during the dot-com bubble. If you take a look at where we're at right now, we peaked, right? Shortly after the pandemic, or right around the pandemic. Maybe if you ask my opinion, this is right around 2021. It's not super clear because of how this table is constructed. But to me, this screams like the bear market peak. Okay. And then we have October 2023, right around here. And you see that this has overall just been in a very strong downtrend since then. And what happened is you had companies realizing, and when I say companies, I'm more specifically talking about the biggest companies in the world, which oftentimes are the biggest tech companies in the stock market, becoming more efficient. And when we say becoming more efficient, that's very fancy for laying people off, right? And getting rid of employees, and using this technology that they're creating and innovating to become more efficient and streamline efficiency, streamline workflows, find ways to have one person do three jobs, right? What used to take three people can now only take one person because of AI streamlining processes and workflow efficiency improvements. And we're just seeing these biggest companies in the world. A big reason that they're going so high in price, and the reason that their price has just been accelerating to the upside so much, is a result of this, right? Is that these companies are just becoming more and more efficient. They're generating more and more cash flow. And, at the moment, everyone's very bullish on AI as they reinvest their cash flow and profits back into AI to potentially become more efficient and generate future profit revenues in income streams. Now, Berkshire Hathaway cash and equivalents relative to the market cap. So if you take a look at this, the average is 25%, but as you can see, it's gone very elevated, right? Let's take a look at 2000 here. Over 40% cash, and it ended up going up near 60%, right? And then what do we see? They went on a shopping spree, right? Right around here in between 2002 and 2003, they depleted tons of their cash and came down to about 10% cash as an equivalent to its market cap. This means that they went shopping. They went shopping big time, right? And what do you see? You see that this thing spikes a lot, right? It's very common for this to spike and for them to have well over 40% cash equivalents. We're currently at 31% right now. Now, the bearish thesis here and the bearish argument is that this is going to continue to rise, okay? Is that Berkshire Hathaway, Warren Buffett is going to say there's not any good deals in the stock market. Everything is overvalued. He's going to continue to sell stocks and continue to raise his cash equivalents. But what I want people to realize currently at the moment is that, yes, even though they've been selling large amounts of Apple and selling stocks and increasing their cash, it's only 6% above the average. And even then, we've seen it much higher. We've seen it well above 40%, as I mentioned, near 60%. So it's not really anything to scream about or panic about when you put those things into perspective. Now, the Fed's reverse repo facility usage has just sunk below 300 billion. The reverse repo tool is a tool used by the Fed to help manage short-term interest rates and make sure that the supply of reserves in the banking system remains appropriate. Now, this chart points to a significant shift in liquidity management practices of banks and changes in the broader economic and financial environment ahead of potential rate cuts. What's really important about this chart, if you don't understand everything we said, take a look at where this chart was last at these levels, and it was at the bull market peak in the beginning of the last bear market. And yet again, here we are back at those same exact levels. So this is a cause for concern and something to monitor. Now, another thing I want to mention is everyone's screaming for yet again another bear market. Just realize that it's 2024 right now. We had a bear market in 2020. We had a bear market in 2022. We've had 2 bear markets in the past 5 years. That is a lot, okay? That's 40% of the time, essentially, we've been in a bear market. So I understand why a lot of people are calling for another bear market, because so many people have been scarred by bear markets in the past couple of years. But when you put things into perspective and you take a look at the long-term time horizon of the stock market, we're not in a bear market twice every 5 years. Okay, that's just generally not how the stock market works. And the other thing to consider is that we often have, secular and secular markets, right? So we can be in a secular trend, right? Maybe a secular bull market per se with a cyclical bear market, right? So what that means is that there's a longer, 5, 10, 15, 20-year uptrend, but then you get these periodic bear markets inside of those, and those are areas for you to capitalize, right? The big thing to be concerned about is whenever you're in those secular bear markets, and in a secular bear market, you're going to be in a bear market that lasts years and years and years, with, periodic bullish cycles in between those. Now, moving forward, the CTA cheat sheet right here is going to be pretty important in my opinion. And one of the reasons why we could see, some of these bear scenarios play out in the stock market heading into October and September. Now, I've already covered a lot of this and a lot of the warning signs from a technical analysis perspective of why we're going to sell off, right? A big part of it, I think, is just due to, election year seasonality. The market does not like uncertainty. And as we head closer and closer to the election cycle, the stock market's going to be becoming more concerned about the uncertainty surrounding who's going to win the election. And then if you look at history, it doesn't matter if it's a red or a blue that wins the election. The certainty of knowing the upcoming potential policies is a good thing for the market. The market likes certainty, doesn't like uncertainty, and we typically bottom shortly after the election cycle or around the election, for a nice rally into the end of the year. And this seasonally is a very weak period heading into September, and October generally are not the best months for the stock market. So keep that in mind when looking at some of these things like the CTA cheat sheet. Now, over the next week, okay, the next 1 week, if we have a flat tape, CTAs have 50 billion to sell, and in SPX specifically, they have 9 billion to sell. Now, if we have an up tape, okay, they've got 33 billion to sell and 6 billion to sell. And if we've got a down tape, they've got 77 billion to sell and 18 billion to sell. So what's shocking and what's most important about this is that no matter what, if we're in a flat tape, up tape, or down tape, CTAs are set to sell. Okay, they are set to sell right now. Now, over here, when we look at the next 1 month, if we're in a flat tape, they've got 96 billion to sell. If we're in an up tape, they've got 40 billion to sell. And if we're in a down tape, they've got 211 billion to sell. So again, CTAs are going to be dumping. Don't let anybody fool you. It doesn't matter if the market's rallying higher. And this is something that I mentioned to some people, is that, in my opinion, we're in a sell the rip market at the moment. Now, we don't know how long that'll last. My assumption and my honest guess is that this could last into September and October. Okay, where we're going to see probably some impressive rallies to the upside. Hey, and we're in an extremely volatile market. The VIX is elevated. It's pricing in 1 to 2% moves on the stock market every single day. And in that condition, I do think that it's possible we're going to end up seeing a lot of institutions such as CTAs and others remain sellers throughout this. And rather than looking to sell into lows and sell into strengthness or weakness, they're going to look to sell into strength, right? And sell into up days. All right, that's my honest opinion about it. But when you take a look at the CTAs, they are programmed to sell billions and billions of dollars over the coming weeks and months. or over the coming week and month. Now, this is basically another way to look at it. So if we're down one standard deviation, that's going to be this purple line here. If we're down two standard deviations, that's going to be this yellow line here. And, you know, essentially, again, this is just reiterating that they are designed to sell. Okay, right now they're pretty much programmed to sell and be negative, right? This is zero right here. And so you can see that they're still going to be selling overall, right? They're still going to be in negative territory no matter what. And the CTAs are going to be selling, which could result in hedge funds, institutions, you know, the real big players in the market, you know, selling also and being sellers just in, even if the market's ripping higher, right? And we're seeing large movements upwards. Now, the VIX crisis spikes. Okay. We kind of touched on this earlier. We're going to revisit this. This was the great financial crisis. Okay. Take a look at the 2000s over here. This is the 2000s. The VIX, look at how high the VIX went, guys. Went above 65. This is absolutely insane. So, yeah, I mean, we had the great financial crisis, a serious concern, right? Something very serious. We had the global pandemic. And then again, we had Japan raise rates 25 basis points, and that caused the third largest panic that we've ever seen in the VIX. Now, here is our bearish scenario for the SPY, for the S&P 500 cash ETF. And so what we're going to be looking at here, right? Typically, the market moves in 3-wave or in 5-wave structures, okay? And so a correction of the overall trend, which we've been in a very bullish trend here recently, typically will come in a 3-wave structure in the form of an ABC, right? That's going to be our A wave down, our B up, and our C down. So it is very possible that the stock market has bottomed. Okay, we did come and close, or rather open right here at a C wave target. Okay, but typically an ABC is going to hit your 1.0 extension. Now, what we did here was we actually came to the 2.618 Fibonacci extension. That oftentimes is a signal of a 5-wave move to the downside. Okay. Now, again, like I mentioned, it's possible that this is an ABC correction. Okay. 1, 2, 3 to the downside. And we put in a bottom, and the stock market is going to head up towards all-time highs and make new all-time highs. But if this is, you know, a 5-wave structure to the downside, and being that we extended wave 3 right here, so 1, 2, 3 to the downside and hit a 2.618 extension, wave 5 potentially is going to come down here towards the 4.236 extension, which would put the SPY back all the way in the 480s. Now, that's just a possible scenario here, but it is something you want to monitor. And I'll be looking closely if we get something like a gap fill reversal. Now, these blue boxes here, these are gaps, right? So we gap down. We've already filled this gap up, right? We have this gap up to fill, and we have this gap up to fill. About 90% of the time, the stock market is going to fill these gaps to the upside. It's just a matter of when, not so much if, right? It could take days, it could take weeks, months, it could take years for some of these gaps to fill. Now, we've already filled this gap here in a very quick manner. Typically, 1, 2, 3, your wave 4, okay, can either come in a 3-wave bounce to the upside, right? So we've already gotten a move up and gotten a correction to the downside, right? So we had a 1, 2. This could be the 3 up here heading towards that gap fill reversal, which is going to be right around 540 on the SPY. Okay. Now, anything below 537 specifically. Why 537? Because that's our wave 1 lows. Okay. So the wave 1 lows here are 537. 537.71 roughly. Okay. Is going to be almost more of the exact level. Wave 4, okay, is not allowed to retrace, you know, back above wave 1. Okay, so if we retrace back above here, we're going to start invalidating a lot of this Elliott wave theory analysis. Now, it doesn't invalidate a bearish scenario, but when it comes to price targets to the downside, it starts to invalidate some of the Elliott wave analysis here. Okay, so that's something to keep in mind. Now, as I mentioned, trading above this 537.71 does not invalidate the bearish scenario. Okay, we could get a gap fill reversal where we come up, fill this gap, and reverse back to the downside to retest lows, potentially even break through those lows and make new lows to the downside. What the bulls want to see here, okay, and if you're a bull and you want to see the market really give you a signal that we could be potentially heading back towards all-time highs, is going to be trading above this 61.8% retracement level, which is 554, okay? And why? Because the odds greatly increase of a 100% retracement back up to the all-time highs once you're trading and holding above the 61.8% retracement level. So this means that if we do something like this and get above and hold this level and maintain above this level, the odds greatly increase we go back to all-time highs. But keep in mind, we could get the gap fill reversal, reject, head back lower. We could come up, retest this level, reject here, head back lower. Or we could get a false breakout, right? Essentially, which would be a look above and fail. So we peak above this 61.8% fib level. We try to hold it, right? Maybe we retest it and then we fall back down below. That's going to be signs of a blow off top at that level, similar to what we had over here, right? Where we had a little bit of a blow off top and then we had a massive move to the downside. That's essentially your textbook blow off top right there. And so if 554, okay, 544, below that level, we're ultimately going to be bearish on the market, right? Now, this doesn't mean on a shorter term time frame that you can't be bullish, heading towards there and see trade setups heading up towards there. But ultimately, if we keep maintaining below 544, we know that the odds are more likely of downwards movement. And we know that above 544 and holding above 544, we know that the odds are greatly increased of a retracement back towards all-time highs. This is based off of the current lows, which are right around 510. Now, again, when you zoom out and you take a look at the weekly time frame, we got a bearish engulfing candlestick right here. Now, for all the Discord members, as soon as we got this candlestick, I went ahead and highlighted what's happened every single time that we've gotten a bearish engulfing candlestick on the weekly time frame for SPY. The first one led us into the bear market, okay, in 2022. We got a bearish engulfer right here. It led to a 25% drawdown. Now, after we came out of the bear market, we had a bearish engulfing here. All right, that led us into the October lows. Okay, now the first bearish engulfer led to about a 6% drawdown. The second one led to about a 2.5% drawdown. Right, the third bearish engulfing candlestick that we've seen since the bear market has ended led to about a 5% drawdown. Currently, this most recent bearish engulfing candlestick led to about almost a 7% drop from the last bearish engulfing candlestick close. And this is something that I was telling a lot of the members about and just saying, hey, when we got this, now is necessarily not the time to be very bullish. Okay. We went over other things as well, but specifically, we knew that 100% of the time since the last bear market started, every single time we've gotten a bearish engulfing candlestick, which is a rare occurrence on the weekly time frame for SPY, it has always led to lower prices. Okay. And we are seeing that now. Does that mean the bullish thesis is over? No, we've got a low, got higher low, higher low, higher low, higher low. Most recently, we've got a higher low, and yet again, another higher low. So we are still in a very, very, very strong uptrend. Okay, we have not started producing lower lows on a weekly time frame. For us to do that, we need to be closing below 495. All right. Now remember, the bearish scenario for SPY is going to potentially put us right around that 490, 480 area, right? If we go back to that chart, take a look, it could potentially put us into those 480s, okay? So it's going to be really important over the coming weeks and months to see whether or not we chop around or whether or not we end up actually putting in this low and then yet again another lower low on the weekly time frame. Now, when you zoom out to the monthly time frame, we went over with the members, hey, above 520, everything is still bullish. When you're looking at a monthly time frame, you're not panicking over this candle right here because it's the beginning of the month and you know that there's still a whole month left to trade, and we really are basing these things off of the closes. So the monthly candlestick close is very important. Above 520, we're still in a very strong uptrend. Even below 520, we're still in a strong uptrend, but we could potentially start to put in as we mentioned on the weekly time frame, lows and lower lows. So we need to monitor that. Now, one thing that's really important about the monthly time frame is we did top out here at 565, right at a minor bullish price target, right? The primary bullish price target up above is going to be right around 589, but we did have a minor bullish price target here of 565, and we did top out pretty much exactly right around that level. Now, what's really interesting about the S&P 500 is that we tend to visit the 50-day moving average, this 50-day simple moving average, about every 2 to 3 months. What does this mean? About every 40 to 90 days. So you can take a screenshot of this chart right here, or I'm sorry, every 60 to 90 days, and you'll see that, you know, the different periods that we've gone between touching the 50-period moving average has been 78, 161. This was really extended during that extremely bullish cycle that we had this year. We had 65, 55, 51, 64, 56, 83, 70, 77, 64, 75, 86, 80, 63, 53, 113. So when you just not overcomplicate it and just simplify it, it appears to be roughly around every 60 to 90 days, we revisit the 50-day moving average. So if you're at an extended period, right, of, you know, over 2 months and approaching 3 months and getting closer to 3 months without revisiting the 50-day simple moving average, well, you can have, you know, a little bit of an assurance that price is going to mean revert back towards that 50-day moving average, whether we're trading below the 50-day moving average, whether we're trading, you know, above the 50-day moving average. It's very common for us to mean revert back towards that 50-day moving average, roughly 60 to 90 days. So I think that that's extremely useful. That's something that not a lot of people know. That's something that not a lot of people share. And it's something that, you know, potentially could give you an edge heading forward into the market. If we're 100 days trading past our 50-day moving average since the last time we touched it, maybe you don't want to be overly aggressive in the underlying trend, whether it's an uptrend or downtrend, because, you know, typically we get that mean reversion back towards the 50-day moving average about every 60 to 90 days. So like these extended periods where we had 109 you know, bars, 161 days, you know, do you want to be getting overly aggressive here? No, right? Maybe you just want to sit it out, wait to see if we can come back down towards that 50-period moving average and look at that as a potential dip buying opportunity. Same thing on the downside, right? When we're trading below, and we've got about 60 days right here trading below, you know, the 50 SMA. Are you going to be looking to short everything right here when we're 53 days below, trading below the 50 SMA? And you know that typically every 60 to 90 days we come back and, you know, mean revert to that 50 SMA. No, maybe you want to wait for a better short opportunity, or maybe you just don't want to short at all, right? That's how I would use this information. Now let's get into TLT. All right, TLT is lining up and trading very perfectly. Okay, the wave three. So before we get too complicated, okay, there's a lot of numbers on the chart. Okay, overall on a larger time frame analysis, what we're looking at is a 1 up, 2 down, 3 up, which is going to put us somewhere around 110. And then another 4 down and 5 up, which is going to put us somewhere around 115 to potentially 120 area. All right. That's what we're tracking in the longer term. But on the shorter term, heading into 2025, all right, and for 2025, the bullish price targets are going to be right around 109 to 110. Okay. And that is going to be our wave 5 targets of wave 3, right? So we talked about the larger wave 3. Okay. And I told you guys how markets move in 3-wave or 5-wave structures. Okay. Wave 3 is typically composed of 5 bullish waves. So you have wave 1, 2, 3, which is going to take us to around 101 to about 105, somewhere in between there. Then we'll get a pullback for wave 4 and head up towards those 109 to 110 targets. Those are the targets for later in 2025. It's very possible we could hit those targets much sooner if we get, you know, accelerated rate cuts from the Fed. But so far, things are tracking very nicely. Now, remember, we're currently in the wave 3 process, targeting up to that 101 to about 105 area. And in that wave 3, okay, as we talked about, wave 3 should have 5 waves to the upside, we just hit our wave 3 targets. Okay, so we have a primary count. Okay, we have the primary count is going to be these right here. We have a minor count, okay, which is going to be this right here, this 1 2 3 4 5 heading up to 109 110. And then we have a minute count, okay, which is this right here, which we did this perfectly, right? I mean, it really doesn't get much better than this. We had one up, wave 2 came right down to the 61.8% retracement level. We hit wave 3 targets, which was right at the 1.618 Fibonacci extension level, and we've pulled back now into wave 4 territory. Now, if you're in the Discord, you guys know I posted the profits on it, right? The call options on TLT went up over 300%, over 100%. I've got many different dates and expirations and strike prices on TLT. The shorter term September call options went up, well over 300%. Once we came up here to these bullish price targets for wave 3, we trimmed those. And now we're in wave 4 territory. And now I've begun adding to longer dated call options, right? October, November, December, January call options for TLT. Because again, we're in that wave 4 territory, and we really just need to validate all of this. We want to maintain above this level right here, which is going to be, a little bit below 95, right? So for the most part, TLT, as long as we stay above 95, this is going to be a bullish look for bonds, a bullish look for TLT. The thing about wave 4s is they're very messy. Okay, oftentimes they come in the form of an A, B, C, D, E triangle pattern. Sometimes they come in the form of falling wedges. All right, sometimes they come in the form of ABCs. They're very messy. They're very choppy. Okay, so I'm not expecting a super explosive move to the upside to finish wave 5, heading us up to, the 100 to 105 territory. I'm not expecting that to come very explosive. But if you kind of just think about the process, right, and think about the timeline of events that we're in right now, with everyone expecting Fed rate cuts in September, it is very likely that we do hit those wave 5 targets in September around the Fed rate cut cycle if we do get those rate cuts. And it makes a lot of sense in the meantime for TLT to chop until we get that clarity from the Fed around the Fed rate cuts and whether or not we get the Fed rate cuts. So I don't think you need to be going all in on TLT, expecting very quick, rapid movements. We already had a very explosive move from 91.50 up to 98.88. Again, respecting the levels exactly to the T. If you want this analysis, don't forget you can join the Discord, because inside of the Discord, I've been posting these charts for a very long time, and I also put them out on the YouTube channel as well. So be sure to smash the like button and subscribe so you don't miss any more. Now, the 10-year yield. If we want TLT to hit new highs, right, we need the 10-year yield. We need treasury yields to make new lows. So 3.785 is really that key level that I'm watching on the TNX. I mean, anyone can look at this and tell you that this looks like a top, right? This looks like an inverse cup. Potentially we bounce around right here, make an inverse cup and handle, and then we get that flush and follow through to the downside towards 3.53% on the 10-year yield. Now, this is the weekly chart for TLT. I told you guys I was going to go over the 3 main things, right, that we wanted to see. Number 1 is going to be the anchored VWAP from the lows, right? An anchored VWAP is a volume weighted average price anchored to a specific price and time and date, specifically to the lows on TLT. Above an anchored VWAP, you're bullish. Below an anchored VWAP, you're bearish. Okay. And what we had was a pinch, right? We had price pinching in between the anchored VWAP from the lows and the anchored VWAP from the most recent highs, in the set of lower highs, right? Where we had a high, we had a lower high, lower high, lower high. So this lower high right here, we anchored a VWAP to there. Okay, which was basically the high for 2023, in October of 2022 or 2023 area. And, we were pinching in between there. And then we also had this trend line that we kept rejecting, right? We rejected it here, we rejected it here, we rejected it over here again. We kept rejecting this trend line. And, the 3 things that we wanted to see on TLT was close above all 3 of these, right? We wanted to close above the trend line, and we wanted to close above both of the anchored VWAPs, and we did that, right? If we did that, our bullish price target up here was 99.27. You can see we exceeded just above that bullish price target. And take a look at where TLT bounced, right here at that anchored VWAP. So For now, we're going to remain bullish on TLT, as I mentioned, really above that 95-ish level, but ultimately above this anchored VWAP from the weekly time frame of the high here at 109.68 on TLT, right? Above there, bulls are in control of bonds, and we're going to gradually continue to see them close higher. And you can use this as a little bit of a trailing stop loss to keep your risk level very well defined and minimal. Now, the daily chart breakout, again, here's that anchored VWAP from the lows. We went over that in the last video, and we said, hey, if we get above this anchored VWAP, we're bullish, right? And we know bulls are going to be in control. And you can see we had that very accelerated move, largely caused by the Japanese yield, the unemployment rate numbers, the labor market numbers, and CPI, and also the Fed speech here recently. Now, this is the bearish cycle completion. Okay, so remember, as we mentioned, we talked about how markets move in 5-wave and 3-wave structures, right? We had a 1, 2, 3, 4, 5 down. So we completed that, okay? And typically you're going to look for an ABC type of correction afterwards. Now, this ABC correction does not have to go all the way up to the 61.8% retracement level. It can get stopped short at a 50%, can get stopped short at a 38.2, or potentially even a 23.6. These two are not the common areas for a Fibonacci, retracement and Elliott wave cycle to, finish a correction at, but it is possible. All right, most likely it's going to come up towards this 115 to about 135 level, but this is going to take years. Okay, this isn't going to be something that's going to happen very soon and very immediately. Of course, if we go into some huge bear market recession and the Fed starts cutting interest rates down towards zero, that can accelerate this a lot. But when you overlay some of those price targets that we looked at, right, and we're tracking wave A right here, this is typically a 5-wave move. So when we talked about that primary 5-wave cycle, right, that we were talking about on TLT, right? So we come back here and go back to this chart, and we talk about that primary 5-wave cycle sending us up into the 120s, right? The 1, 2, 3, 4, 5 here, that primary cycle, all of that is simply just wave A. And then we would expect a correction, and then ultimately another leg up that could potentially take us up to that 127 to 137 area for TLT. Now, that's it for today's video. I hope you guys really enjoyed it. If you did, you're going to love all of the analysis and trade ideas that you get inside of the Investment Intelligence private trading group. Remember, you can join now for just $1 for your first month using that promo code SUMMER. The link is in the description to join. What's inside, you'll get 20+ swing trade ideas every single week. You get custom scripts and indicators that I use on a daily basis. You get exclusive intel such as unusual options activity, dark pool data, gamma levels, and more, as well as exclusive chart layouts. And you can also just join the Investment Intelligence newsletter. Okay, you can sign up for that using the link in the description. That's completely free. It doesn't cost you a thing. And if you enjoy it and it's something that you want sent directly to your email inbox, you can get those directly by signing up in the link in the description below. And if you ever want to do a coaching session, a one-on-one session, I do a lot of those. I've done those for options. A lot of people want to go over options trading. A lot of people want to go over day trading dynamics, swing trading strategies, interactive Q&A. You can sign up for those directly in my Ko-Fi page using the link in the description. You just simply click on the commissions tab, and in there you can book a 30-minute or a 1-hour session. You can also click on this buy a coffee button, basically a way to leave a tip or donation for all the free valuable content I put out, such as the newsletters, such as these YouTube videos. Thanks again for watching. Don't forget to smash the like button, subscribe. And if you enjoyed today's video, share the channel, okay? Share the video. Help me get to 10K subscribers, guys. I'm only about 1,000 subscribers away. I'm about to hit that 9,000 subscriber threshold, and I'd love for you guys to help me with your support, get to 10,000 subscribers.